Hello class, this is Brian from FinancialTradingSchool.com and welcome to GT308 Hyperinflation. So as a prerequisite for this lesson, you must have watched both GT306 Creation of Money and GT307 Inflation. This lesson will be continuing where I left off in both of those lessons. As a recap, in GT306 Creation of Money, after money was injected into the money or banking system, we ultimately arrived at the money multiplier. This effectively determines how much money exists on the books, e.g. on paper. And then in GT307 Inflation, I explained the concept of inflation via two perfect world examples. I then went on to explain how the money supply has been steadily increasing for the past century, which results in a 2 to 3% target inflation rate on a year-to-year basis. At the end of the lesson, I started talking about the sudden surge in money supply from the financial crisis in 2008, and how this would ultimately lead to hyperinflation. So this is where I will be picking up the lesson again. So let's start off with two more scenarios to show what hyperinflation is, and then I'll explain why it hasn't happened in the economy yet, and how you can combat hyperinflation. So let's get started. So let's start off with the definition of hyperinflation first. Hyperinflation is where you have extremely rapid or out of control inflation. There is no precise numerical definition to hyperinflation. Hyperinflation is a situation where the price increases are so out of control that the concept of inflation is meaningless. This is basically what I was saying in the last lesson in GT307 Inflation, where with a 2 to 3% inflation rate, it just happens as part of your daily life. It's not really affecting you. Whereas hyperinflation, as soon as it kicks in, it happens so fast that you really don't know what to do because it's out of control. So let's just explain what it is with two scenarios. First one, we're going to continue with the perfect world scenario, and then in scenario number 4, we're going to talk about in reality what actually happens. So in the perfect world, what we're going to have is we're going to have the same 10 people as before, and we're going to have 10 apples in the room. Continuing from last time, scenario number 1, they only had $1 each. Scenario number 2, they only had $2 each. Now scenario number 3, with hyperinflation, what they're going to have is they're going to have $10 each. And I'm pretty sure you can see where I'm going with this. 10 people, 10 apples, $10 each. They're going to logically come to the conclusion of each apple is worth $10 each. And that's hyperinflation in effect. And depending on the time frame, if it happens, say, overnight, over a week, over a month, over a year, don't know how long it takes, but depending on how fast it happens, that's a really drastic, big increase, which is why it's out of control. Because ultimately speaking, how can you deal with it if it happens in such a short time frame? That's the ultimate question. But keep in mind, so far the first 3 scenarios, the 2 in the last video and the 1 in this video so far, these are all perfect world scenarios. This is where everyone is equal, everybody has the same exact amount of money, so it's all fine. In reality, this is not the case. So in reality, basically what happens is it looks something more like this, where you have the 1% rich people in the world, and then you have the middle class and the poor class, the poor making up the majority of the population. So let's say we have, say, 100 people, and you only have 100 apples. So there's still the same number of equal apples to the number of people, but money is distributed differently. So let's say we go in line with something similar to the 1%, but instead we have something like, say, 10 people have $100 each, and then we have, I guess, in the middle you have, say, 30 people, so that the majority is still the poor people. 30 people have, say, $50, and then the remaining 60 people only have, say, $10. Basically what happens is, in this case, it's no longer equal. The apples will not be equally distributed between everybody. Basically what happens is the 10 people at the top, the rich people, they will bid up the prices, get as many apples as they can, because they can do that, because they have enough money to do so, and they know the general market price will be probably, say, $50. Because $50, which will mean the 30 people get it, and the 10 people will get it for sure, and they not only get 1, but they also get 2 apples. And in doing so, they pretty much screw over the poor people at the bottom at $10. So the people with $10, they're struggling to buy the commodities in this economy, which is why hyperinflation is a nightmare scenario for the economy. Something to keep in mind though, obviously this is a drastic example, because in this example we're effectively wiping out 60 people, or in this case the economy is, say, 100 people, we're wiping out 60% of the economy. That's a drastic example. It obviously won't happen like that in reality because the government's going to step in and they're going to subsidize a few things and they're going to have welfare and food rations and all that stuff. Because as you can see, this is obviously a very big problem. So now you're probably wondering, why hasn't this happened in the economy yet? So let's go back to what we learned in GT306, creation of money. In GT306, I drew a similar diagram to this, where you have a central bank on the top, which is outside of the economy, and then in the bottom, which is inside the economy, you have 9 circles. If I recall correctly, the 9 banks were involved in the first bailout. This is basically what happened in 2008. The Fed give money to the 9 banks, expecting them to push the liquidity into the markets, such that the money would enter the money system, as we learned it in GT306. But instead, what happened was the money just pooled. It got stuck. The banks didn't do anything. The banks just kept it, which is why for the past 5 years we've pretty much been still stuck in a recession, because there hasn't been an expansion yet. In order to expand, the banks have to loan money to small businesses so that they can build businesses so that the economy can get going. But if the money is just pooled and it stops here, because as you guys remember, we had increases in unemployment, companies were downsizing, companies were restricting employment, they weren't hiring new workers, they were laying off old workers, they just kept the money. So if money is stored, it's just stopping at the first level, it's not entering the economy, then it's just stuck. So what we have is hyperinflation is about to happen, but it hasn't happened yet. As soon as these banks decide to let the floodgates flow and open the doors and the money enters the economy, that's about the time when hyperinflation happens, assuming it pans out the way I see it. Obviously, this is just theory, so keep that in mind. This is completely theoretical because this hasn't happened yet. And this is one of the theories as to why I think it hasn't happened yet. Some people agree with what I say here. If you talk to economists, they might say different things, but this is my view on it. And based on what I learned in economics, this should be why it hasn't happened yet. As to what happens when it does actually happen, I don't know how fast it'll be, considering how fast currency markets are nowadays compared to, say, Germany in the 1920s. Their markets were still relatively fast in terms of the banking system, but it's not as fast as it is now. Right now, the money markets are just so fast. The effects could happen literally overnight or over a week in very short times, versus a century ago, it could take maybe a week or a month before the rest of the world felt the effects. But now, if one country goes down, the whole world will feel it overnight, and then everything just falls down. So that's what happens with hyperinflation, and this is why it hasn't happened yet. So to end off this lesson, how do you combat hyperinflation? So as I mentioned in the beginning of this lesson, hyperinflation is just out of control inflation, which is where prices go up so much that your currency effectively becomes worthless. So there's 2 things here: currency devaluation and commodity increasing in prices. So how do you combat this? You need to either A, switch currencies, switch to something that's more stable or appreciating, not depreciating, or alternatively, stock up on commodities or goods or whatever that will appreciate in price, that will be similar to the hyperinflation. So I don't want to make any investment advice here, so just a risk disclaimer: don't follow this because this is just for educational purposes. But most people, when they think of inflation, they go to metals. So they buy gold or buy silver, which is why for the past 5 years, since 2008, you've been seeing gold prices spike up and silver prices spiking up. But recently, since the Fed announced that they would stop buying bonds and stop printing money effectively, gold prices and silver prices have been dropping. So in the short term, that may be the case. Long term, when hyperinflation kicks in, the prices are just going to skyrocket again. Then other things you could look at is oil, but oil is not really something for consumers. Metals is the safest bet. Otherwise, something else you could do is you could invest in the stock market. Stock market is obviously a little more dangerous than gold and silver, but stock market, equity markets will rise effectively according to how much money is out there as well. On that note, there's something interesting to note about the Dow Jones and the S&P. Something that you may consider looking up on Google is the Dow Jones and S&P in real terms, because what you see on Google Finance or Free Stock Charts or whatever charting platform you use for the Dow Jones and S&P right now, The Dow Jones in 2008 or 2007 was, I think, around the 14,000 level, and currently now it's around the 15,000 level. Yes, it is higher than the previous high, but this is on a nominal scale. If you look on a real scale, in real terms, taking into account inflation and how much money's out there, the 15,000 doesn't represent that much. Technically speaking, if you factor in hyperinflation, inflation, and all that stuff, the 14,000 was the previous high. The new high should technically be around, I would say, probably 16,000, 17,000 in the short term, maybe even up to 20,000, 25,000 in the long term after hyperinflation kicks in. Like, if you look at the real term chart, I don't have it right now with me. It's pretty interesting stuff. Like, since I think 2000, early 2000, when Bush lowered the interest rate, that's when the Dow Jones started sinking due to inflation on real terms. Rather than, if you look at nominal, the Dow's been going up for the past 10 years. But if you look in real terms, it's been going down for the past 10 years. And that's something interesting to know. So you could invest in stock market. That's a possibility, but I'm not giving any investment advice here. Obviously, you need to pick the right stocks and pick a growth stock so that you can combat hyperinflation effectively. The reason why you want to invest in a commodity that rises in price or switch currencies so that you don't get devaluation is so that in the event prices do go up, you at least have the same amount of money to buy the same amount of goods. Because if you do not do this and you hold money versus commodities, then your money will be worth less, which means you buy less stuff. Versus if you hold gold, which, let's, for the sake of example, say it goes up the same rate as hyperinflation for currency going down. If it goes up at the same rate, then you can just sell gold at that point in time and still be able to buy the same amount of goods as you can buy now without inflation kicking in. So that's why you want to do this. This is effectively what rich people do. They switch between money and commodities, or investments, etc. over time, depending on what time period it is. Depending on interest rates going up or going down, money supply going up, going down, and vice versa. Depending on what period it is, they hold a certain thing. Because during specific periods, it's better to hold one thing than the other. So this will ultimately become another lesson in the future as well. What I'll talk about most likely will revolve around bonds, which is an area that I'm not heavily invested in yet because I haven't bothered learning about bonds yet. Bonds is mainly for people who have a lot of money and don't want to take risks. Since I'm young, I'm not really in that area of investing yet. I'm more of a risk taker now. But ultimately, that lesson will revolve around bonds, interest rates, and money. So depending on where interest rates are, you will either hold bonds or you'll hold money. But that's for another lesson. So that pretty much concludes this lesson on hyperinflation. This lesson concludes the last three, I guess, money lessons, because we covered creation of money in GT306, inflation in GT307, and now this lesson, GT308, hyperinflation. This concludes the money lessons. Hopefully you guys enjoyed these three lessons on money, and I will see you guys next time.